inflation is going to be much higher. And that's why the gold price is rising the way it is. And that's why bonds are falling, because inflation is bearish for bonds and bullish for gold. And so they're doing exactly what you would expect that they would do. We have new 52-week highs, multi-year highs in the GDX and the GDXJ. The next key resistance is to really take out the 2020 COVID high. Even though gold itself and now silver, both metals are higher than they were in early 2020. Neither of the gold stock indexes, or there's more than two, but none of the gold stock indexes have taken out their highs yet from early 2020. That's coming up. That may happen this week.
Inflation is expected to rise significantly, driving the gold price up and causing bond prices to fall. While there hasn't been a dramatic surge in mining stocks, we see new multi-year highs in the GDX and GDXJ indexes. However, neither of these gold stock indexes has yet surpassed their highs from early 2020, despite gold and silver prices being higher than they were then. The speaker, Peter Schiff, discusses the rising prices of silver and encourages listeners to purchase it. In contrast, prices are still relatively low, emphasizing that acquiring more ounces at lower prices is beneficial. Recently, silver prices have been gaining momentum, with a notable breakout above $33 per ounce, reflecting a combination of factors driving demand. Analysts suggest that this increase is tied to a surge in industrial demand, particularly in the electronics and renewable energy sectors. According to the Silver Institute, record physical demand is anticipated for 2024 as industries ramp up their usage of silver. An American financial commentator, Peter Schiff, emphasizes the broader economic significance of gold and silver. While the stock market may seem intense, he argues it has declined when measured in gold. He highlights the unexpected rise in bond yields, particularly on 10-year and 30-year U.S. Treasuries, following Federal Reserve rate cuts, countering the Fed's goal of lowering borrowing costs. Peter Schiff points out the unexpected rise in long-term interest rates and gold prices, which contradicts the common belief that higher interest rates are bearish for gold. If you enjoyed the video, give it a thumbs up and subscribe for updates. With only 20% of viewers subscribed, help us reach our goal of 1,000 subscribers. Your support makes a difference.
I believe we're going much, much higher, but you might as well pay 35 because you could buy extra silver. And that's what's really going to make a difference. Not that you got the lower price, but the lower price enables you to acquire more ounces for the same amount of money. So that's special. They've extended it. So when you're finished listening to the podcast, go over to Schiff Gold and get some silver, get some of these junk silver $50, while we can still get the price that we negotiated. But, more important too than what's happening in gold and silver is why the significance of what's going on, because these are important metals. So it's not that you could just ignore it and not understand, right? Like, what does this mean that gold is going up so much? People like to talk about, oh, the Dow is up. Yeah, but it's down like 5% this year, priced in real money. You can't just ignore that. Also, what's significant, and I was predicting this, and I don't really know anybody, at least in the mainstream media, who predicted this. That's why they're also, baffled by what's going on, and they're coming up with explanations which are wrong. But bond yields now on a 10-year Treasury closed at 4.21 today. That's up just over 50 basis points from where the yields were when the Fed cut short-term rates by the same amount. The same thing with the 30-year. The yield on the 30-year, when Powell announced that 50 basis point rate cut, 30-year Treasuries were just under 4%. They're like 3.9596, something like that. Now, they're exactly 4.5%. Again, a 50 basis point move. Probably the opposite of what the Fed expected, right? Because they wanted to lower rates because they wanted to bring down borrowing costs. Instead, borrowing costs have gone up. Mortgage rates now are getting close to 7% again. The opposite of what the Fed was hoping to achieve. Credit card rates, of course, never came down, and now they're at new record highs. I mean, I think they're 23, 24% for credit card rates. And of course, people now have record high balances that are now being financed at those record high rates. And that's exactly what's happening. long-term rates and gold prices are rising in tandem. And that is the opposite of what most people think. They think, oh, higher interest rates are bearish for gold, but gold is going up anyway. Now, since the mainstream financial media did not expect this to happen, they thought that when the Fed cut short-term rates, that long-term rates would follow instead of going the opposite direction. The excuse that they are making for what's happening in long rates is they're saying that, well, the economy is not as weak as we thought. And therefore, long-term rates are rising because we just found out that the economy is not as weak as we thought, and so maybe the Fed won't cut rates as much as we thought, and so now the longer end is backing out some of the rate cuts that they had priced in, and that's a bunch of nonsense because the economy is not stronger than we thought. It's actually weaker than anybody thinks. They're basing this idea that the economy is unexpectedly strong pretty much wholly on the non-farm payroll number, the most recent one that we got, that was way ahead of estimates.
The speaker, Peter Schiff, argues that running larger deficits is more harmful to the economy than raising taxes. While cutting government spending would be ideal, it's unlikely to happen. The speaker also discusses Trump's proposal for a 20% across-the-board tariff, which they prefer over targeted tariffs because it could generate more revenue. However, they emphasize that consumers, not foreign producers, ultimately bear the cost of tariffs, similar to sales taxes. The speaker criticizes Trump's claim that China would pay the tariffs, explaining that U.S. consumers end up paying higher prices. The speaker highlights the growing threat to the U.S. dollar due to resource-rich countries like Russia, China, South Africa, and Brazil, increasing their focus on gold and moving away from U.S. treasuries. Sanctions on Russia have backfired by uniting these nations against reliance on the dollar. They emphasize that if these countries hold gold instead of U.S. assets, the U.S. cannot sanction them. The speaker also references an interview with Paul Tudor Jones, noting their similar investment strategies in gold, commodities, and foreign stocks, though they disagree on Bitcoin. Jones suggests inflating the economy to manage debt alongside possible tax hikes. Now, let's recall the interview.
If we cut taxes, we're just going to run bigger deficits. The deficits are more harmful than the taxes. When people talk about, if we raise taxes, it's going to hurt the economy. Not necessarily. If we raise taxes and we get smaller budget deficits, they'll actually help the economy because the deficits are more destructive than the taxes. Now, the best thing to help the economy is to cut government spending, to really substantially cut government spending. But I don't think that's going to happen. And, the tariffs, Trump now also came out and he says now he wants also a 20% across the board tariffs, which I prefer across the board tariffs rather than targeted at particular countries, because a lot of those tariffs backfire and the government doesn't end up collecting the revenue. People just buy from the countries where they don't have the tariff and just pay a higher price than they would have paid if they bought the tariffed items, but it doesn't generate any revenue for the government. It just makes consumers pay more, but the government doesn't get tax revenue. But if the taxes are across the board, well, the government's more likely to get revenue because, no matter who you buy from, you're going to pay the tariff. But again, it's the people, the buyers, the American consumer that pays that tariff, not the foreign producer. He just passes it on, just like sales taxes. When you go to a store, the store doesn't pay the sales tax. You pay the sales tax, right? Same thing with value-added taxes. We don't get a free lunch because we're getting hit with an excise tax. That's the whole point of an indirect tax. The public pays indirect taxes indirectly, but you still pay them. A direct tax, you pay directly. That's where the names come from. So an income tax, a payroll tax, those are direct taxes. You send your money directly to a government. Tariffs and sales taxes, they're indirect taxes. You don't pay the money to the government. You pay the money to the importer. You pay the money to the store. And then the store or the importer sends the money to the government. You pay the tax indirectly. So Trump is being, disingenuous, claiming that it's the Chinese that are going to pay these tariffs. And we're ignoring that. And also part of the impetus to move away from the dollar are the sanctions against Russia. And it's not an accident that the BRICS summit is being held in Russia. I mean, they could have held it in any one of these countries, but they held it in Russia. That is basically a thumb in the eye of the United States because they're saying, hey, we don't care about your sanctions. You know what you can do with your sanctions? We're going to Russia. And by the way, the Russian economy is doing fine. The ruble is doing fine with all these sanctions. We didn't impose the economic chaos that we thought when the sanctions were first put on into Russia. But what we did is we galvanized all these other countries that don't want to be the next Russia when it comes to sanctions. So if they move to gold, which is why they're buying all this gold, we can't sanction their gold. If they own gold and store it within their own borders, we can't do anything about that. Yeah, if they hold U.S. Treasuries, sure, we got them by the balls. That's why they don't want U.S. Treasuries. But the problem is, who's going to buy them? Because we have to sell so many of them. I was listening to an interview today with Paul Tudor Jones, right? He was on CNBC. I mean, he's a good guy. He's a smart guy. I mean, probably one of the smartest ones out there. And we have very similar portfolios. He's invested heavily in gold, commodities, foreign stocks. So we have a lot of the same things. I mean, he owns Bitcoin and I don't own any, and I disagree with him on Bitcoin, but I know that he's in Bitcoin for a trade, right? So he's trading it, he's speculating in it, and I'm sure his position in gold is far larger than his position in Bitcoin, but I really don't know anything about the size of those positions. But he talks about the fact that he owns gold and that he owns Bitcoin and other commodities. But one of the things that he was saying is that we need to inflate our way out of the debt problem. Like that's a positive. Like that's like his prescription. Like we have this big debt problem and his prescription is, well, we need to inflate our way out of this problem. Now, he said we needed some tax hikes, and he talked about maybe 10% hike in the income tax, letting the Trump tax cuts expire.
The speaker discusses economic factors such as rising silver and gold prices, bond yields, deficits, tariffs, and geopolitical shifts threatening the U.S. dollar's dominance. They emphasize the growing importance of precious metals in preserving wealth amidst inflationary pressures and express concern over policy missteps, such as the U.S. reliance on debt and sanctions that may push nations to diversify away from the dollar. While they agree with specific financial strategies like investing in gold, they diverge on others, like the role of Bitcoin and the approach to managing debt through inflation. How might the rise in gold and silver prices impact the global financial system in the long term? I'd love to hear your thoughts on it. Share your comments below. And don't forget to show your support by liking this video, subscribing to the channel, and turning on notifications for more insightful content like this. I'm looking forward to the next video.